like I said, once you're in a bear market, you can make money on the way down just like you can in a bull market on the way up. So, and that's what my focus is now, is really looking for more short calls. I might even do some long puts on companies I think will fall a lot, but I haven't had much luck with them. And now with the volatility index spiking to almost 40, the premiums are quite high for that to do, and the price of the stock has to really drop a lot to profit on your long put. That's why I more like the short calls. And for people that don't know a lot about the options, I'm recommending maybe getting one or two good books and maybe spending six months to a year reading through it and understanding. Especially, you can still, and if you're using leverage, you have to be very careful because you can get the direction right, but you can still get a margin call because the option price is dependent on a couple things. Volatility be one of the biggest things, and delta, which is how much it will drop for a drop in the price of the underlying security. And sometimes the volatility can override that, which it did this week when volatility went from 20 up to 40. So the options, a lot of options, just prices spiked right up, and then that can work against you. So I'm not going to explain all that here. That's a full course, and it's best people just take time to learn that on their own. So last week was a good week for the bond market, of course, because there was no intervention by the Fed, and there is talk of that maybe next week of them saying they're going to cut interest rates by 50 basis points. I'll talk about a little bit about more of that in a bit. But that's kind of a one-time event. Interest rates are so low now, they're getting to a point where they would have to go negative, and I don't know if the states want to go down that road when it's already been tried out in Europe, and it hasn't seemed to really do too much in Europe or Japan, where it's been done for decades. That those economies just seem to be always teetering on a recession. So. But we'll see. And I'm still concerned on the BBB rated bonds by like Moody's and the credit rating agencies. The spread now is so narrow, and we could see a real backup in yields. As I say, the supply chain, if a company can't get parts, a smaller company, for a month, 2 months, 3 months, they can't make their accounts payable, that type of thing, can't make their loan payments, they go into default, then you could start seeing that spread rapidly increase. And we did see the junk bond index drop a lot. And then that could start having a contagion back into the stock market, because if a company goes bankrupt, then typically the investor is the last person, the stock equity investor is the last person in line to receive anything, and seldom do they receive anything. So then we're going to have the market starting to look at all those companies that have fairly leveraged balance sheets and wondering if they're going to make payments, and if the interest rates do start to go up because the bond investors start to anticipate more risk, then that's really going to start to feed into the equity market. That all being said, about all the selling I did buy one company. I'm always trying to look at all ends of the market, and now we're starting to see, track, when I find a company that I like, it looks like it's going to be a grower for a long period of time, but I didn't catch it in time, the valuation's ridiculous, then I just put it on a watch list and put price targets on it. And a company called Illumina, which is a biotech company, basically into like DNA modification, alteration. I'll probably do a full video on this company. I haven't had time to fully go through the numbers on it, but the symbol is ILMN, and you can see behind me it's a company that went from $25 back around 2010 all the way up to $375. So of course I'm disappointed I missed that. But we've gone from 375 all the way down to 265, and now the valuations really aren't too bad. So I opened, still expensive, still could drop $50 if the market ends up being a replay of 2009. This will drop 50%. So, but it's kind of that always transitioning, right? You're always kind of looking ahead a little bit. So I thought, and biotech actually performed not too bad, because everybody was talking about, you know, a company trying to find a vaccine, and they shouldn't be, it's not like the car industry or something like that. If we go into a mild recession, they shouldn't be affected too much. But I'll do probably a separate video on that. And but again, it is one company I did buy. So, and also getting back to the Fed, I think I've said this in the video before. I don't think lowering interest rates is going to have any long-term effect on this. This is kind of a black swan event nobody really expected, kind of outside of what anybody was talking about. And lower interest rates doesn't help a business that can't get parts or they can't get its workers to make it into work each day. Lowering interest, I think if they do lower interest rates, we're going to get a big spike. Maybe, you know, markets go up 1 or 2% or 3% in one day, but I don't think it's going to hold. I think then people will get back to focusing on what's going on with the coronavirus itself. So, but that could happen next week, and there'll be a bit of a pop in the market, and at that time I might even look at doing some more short calls as the stocks come up. But again, I've been fairly aggressive going to the shorter side of things, and I'm still not sure that this thing just can't turn around and you know, come back fairly quickly. But my bias is more that this is going to become fairly prolonged, and companies, especially when they start reporting first quarter earnings, will have to give guidance to the second quarter, and you're going to be looking at companies that will most likely be giving negative guidance, maybe even losses. And I've said in the past, we've already had quite a few quarters now of no earnings growth. So, and if earnings go down, that doesn't really help the, you know, and the stock prices fall. So your numerator and denominator are both falling together, and it doesn't help the valuation of the market. It doesn't make the market really any cheaper. It's not till you get a recovery where the earnings go up and the prices are down that the market starts to look more attractive. So, and just for a bit of history, and the financial crisis, you know, from 2007, 2009, they actually decreased interest rates by the Fed by 5%, and the market still ended up correcting 50%. And we've really got no room. Is the Fed going to go to something like -4%? I don't even know if they can do that. So the amount they really have to work with is so little that it might be a news event for a day, but as far as any long-term positive economic effects from that, I think will be muted or really next to nothing. I don't know if I've got too much else, but last week roughly $3.6 trillion was lost in the market, and it's actually been worse for the larger market. I do have one chart that shows the Russell. Get it here. No, I don't have it here now. Yeah, this here. So this is the NASDAQ, S&P, and Russell. And we had that sell out back in December 2019, which is about a 10% correction, which I've talked about. But we can see now the Russell, which is a very broad measure of the market, it's 2,000 companies versus 500 for the S&P 500, and we're right back to there. So we've basically over a year now, there's been really no growth, and you can see how flat that is. You can see the S&P has gone up quite a bit, and we're still above that low, and the NASDAQ. But the underlying market is actually performing worse than the main indexes. So you're probably looking at 16 or 17%, and lots of smaller companies are probably down